In this video, I'll be providing an update to my business cycle risk score as at December 2019. As a preview, I have seen significant improvements month over month, but as usual, I will take you through exactly what I am seeing and what has changed month over month. Again, I don't necessarily react to changes in the risk score, but use it as a guideline and something to pay attention to as we go forward. If you are new to my channel, my name is Jared Ayers. I am a CFA charter holder, and I've created this channel to share with anyone who's interested the thought processes, techniques, and strategies I use to invest my own money. The content I generally share are like this one, where I will go from a very high level macroeconomic view down to specific strategies and even specific security selections as well. So anything you want to see going forward, please do drop me a comment. So as in previous updates, I will provide a link to the videos where I go through in detail exactly how I build up my business cycle risk score. I do have quite a bit of detail that I will not be sharing in this video. I'll just be skimming the tops of the waves, sharing with you exactly the results of my analysis as opposed to exactly how I build it up. But of course, if you do want to go into a little bit more detail and develop something similar for yourself, I will link back to the videos where I do cover that. Now, without further ado, let's get into the details. So as before, what you're seeing before you is a screen capture of my business cycle risk score update for December 2019. Like I said, I will link to the other more detailed videos where I cover exactly how I build it up, but as a brief reminder for those who are new to my channel or this type of video, I do look at 13 key indicators that I have selected and believe have an impact on where the equity markets might be going. I've just given them a sort of predictive power, either leading or lagging, basically one or the other. The weighting based on that categorization is either 100% or 50%, depending on whether it's leading or lagging. I do capture the date of the data I'm using. And then that also helps me give a time weighting, so the more current the data, the more of a weighting it gets. The less current, the less of a weighting, and that gives me a total weight upon which I apply basically my analysis of both direction and rate of change of each indicator. Rate of change being, as it sounds, sort of, is it, if it's decreasing or increasing, is it doing so at a decelerating or accelerating or a steady pace? So those all influence my total analysis. I then convert everything back to a 10-point scale. So on a scale of 0 to 10, 0 being dire, 10 being amazing, we're seeing a risk score in December of 4.3. So pushing its way up towards the halfway point, but definitely not over halfway, still indicating that I ought to be cautious here at this point, despite what the S&P 500 is doing in terms of breaking new highs. A similar story to other months. Again, the consumer confidence and retail sales are showing very strong indications. Those generally do lag the broader market. I mean, I do have consumer confidence as leading, and that's more due to the reaction of the broader equity markets to that indicator. Also, of course, with consumer confidence strong and retail sales strong, usually you can find unemployment being fairly strong as well, which is the case here, with unemployment decreasing at a steady rate, continuing to do so, and jobless claims being an indicator of unemployment remaining steady and flat, which is good. It's not changing drastically. The other positive, I guess, is the CPI inflation rate. For U.S. inflation, decreasing at a decelerating rate, so a little bit of inflation can be healthy, so that's good. And everything else basically showing pretty much negative, with the exception of the 10-year Treasury yield, which is flat. So a lot of these other indicators, relate more to business confidence and other things like that, which can be telling, kind of very, very kind of forward-looking indicators. So probably a good reason to still remain cautious, although we have seen improvement month over month. So just as a reminder, compared to the prior month, this is November, a much worse situation where only consumer confidence and retail sales were positive. Everything else was negative. Risk score of 2.4, so not very good at all compared to the December reading. Now sometimes that can also be driven by things like the December sort of Santa Claus rally and other things like that propping up other indicators. But generally speaking, I don't look too much into seasonality. These indicators are looked at on a monthly basis, and I try to use the data, blend it over multiple periods to try to smooth it out. So the fact that the S&P 500 is going to new highs now is fantastic, but not necessarily reason why this indicator is improving. So just to recap, also the method I use is when I have my risk score, it basically tells me which asset classes I should be allocating in terms of my whole portfolio. It's between equities, bonds, cash, gold, and managed futures. Right now we are in this range here, 3.7 to 5.0, because we have a 4.3 rating. That tells me I'm kind of in that 40 to 50%, maybe pushing up to 60% equities, some bonds, quite a bit of cash, and then some gold and managed futures. So in terms of how the December reading compares to other months, December 4.33, November again down at 2.4 there. October was a little bit closer to the December rating, and the proportionate allocation to different asset classes for December are also similar to October. Currently we're sitting at 50% equities, bonds 5%, cash 38%, gold 5%, and managed futures 3%. Now of course that is what the risk score is telling me I should do. Again, as in previous videos, I don't necessarily pour myself into the market just because the indicators increased. I take this with a grain of salt and generally watch it, especially if it's spiked up like this month over month. It's a good sign. Hopefully it continues, but it may not. As you can see, it's been a bit choppy over the last few months since June there, reaching a high of 4.92 and a low in August of 1.72. So speaks to the volatility for sure, but overall something to watch as we head towards the new year. So I do hope that was helpful, and stay tuned for next month's update. So I do hope you found that video useful. Again, I want to keep this sort of trend going where I'm updating my indicator analysis once a month. That's about how often I look at it. It doesn't take me very long, but definitely it's the foundation to how I invest my entire portfolio. As I said before, not going to necessarily react to this type of change, but very useful information as we kind of go forward into the new year. If you did like the video, please do give me a thumbs up, hit the like button. If you're new to my channel and you'd like to see similar content going forward but are not yet subscribed, please do hit the subscribe button. And anything you want to comment on regarding this video or perhaps other topics you'd like me to cover going forward, by all means hit me up in the comments as well. Until next time, thank you very much for watching.